So you've started investing in the stock market through a TFSA, an RRSP, or a cash account, but now that you're starting to receive dividend income and your share value is going up, you're left wondering, how am I going to be taxed on my securities, and should I be investing in US equities? Because you've heard about something called withholding tax, but aren't necessarily sure what it is. So what should you do knowing that Uncle Sam is hiding in the shadows trying to bully you for lunch money? Let's find out. Hey, what's going on, investors? I hope you're all having a fantastic day. My name's Griffin, and in today's video, we're going to be speaking about a topic that I'll admit isn't as fun as, say, high-yielding dividend growth stocks or hyper-growth stocks, but nonetheless, this is still a topic that's extremely important that you understand as an investor. We're going to be speaking about taxation and how taxation on your securities and dividends works, whether you're investing in Canadian or US securities, and whether you're investing in either a TFSA, an RRSP, or a cash account. I've actually had quite a few people in the audience reach out to me, basically just wondering if I could make a video on this topic. So obviously it is of need and of interest to the audience, especially because I know a lot of you guys want to invest in US securities in either the NASDAQ or New York Stock Exchange. So obviously this is a topic that's really important. You need to understand how taxation works from foreign securities, and what better time to talk about this topic than right now as we're approaching tax season in the coming months. Now, what exactly is this video all about, and why is it relevant to you as a retail investor in Canada? Well, just like all income that you generate throughout the year, income derives from your investment accounts, such as, for example, dividend income and share appreciation, is income that you need to account for on your tax return. However, with everything that has to do with taxation, there are certain rules and technicalities that you have to follow, and for this reason, you're going to be taxed different depending on the actual securities you hold and the investment accounts that you utilize. So after today's video, you're going to understand everything that has to do with taxation for these different accounts. So with all of that information covered, let's now dive right into how taxation works for each different investment account in Canada. But before we do that, I do just want to put this out there that if you're interested in learning more about taxes this season, then make sure to check out my website, cointocapital.com. There's a link down in the description where I've made a bunch of blog posts related to taxation, and also you're going to be able to find the blog post related to this video. And finally, while we're speaking about freebies here, if you're interested in receiving your own copy of a stock market template that I made in Google Sheets, link down below, where you just need to enter your email address and it'll send you an automatic email where you'll get your own stock market template that you can update to your liking. So on that note, let's get right into the video. All right, so let's start off with the tax-free savings account, also known under the acronym TFSA, which is by far the most popular Canadian registered investment account for all new investors and pretty much just anyone who hasn't yet maxed out their contribution room. If you're a new investor and don't yet know everything there is to know about the TFSA account, then not to worry, I've made a full comprehensive video about the TFSA and how it works for you as an investor, so make sure to check that video out. But in today's video, we're going to be looking at, for example, the TFSA from a taxation standpoint if you were to hold American securities in it and receive a cash dividend, and also what happens when you're holding US securities and you decide to sell them later on down the road. Well, isn't the TFSA tax-free? So why should I ever be paying taxes in this account in the first place? The TFSA is a Canadian registered investment account created by the federal government in order to allow investors to grow their accounts on a tax-free basis. And the reason why this is because your contributions to the account are taxed on the year that you're making those contributions, and therefore you're already taxed on your funds. And there is a contribution limit that you're going to learn all about in that other TFSA video, but this allows investors to then grow their accounts on a tax-free basis. All the dividends they're receiving from Canadian companies, as well as the share appreciation of securities, is going to be completely tax-free later on down the line when they decide to withdraw those funds. To simplify the concept, just remember that all dividends received within your TFSA from Canadian companies, as well as interest on your securities from both Canadian companies and US companies, so stocks from both countries here, is going to be completely tax-free in your TFSA upon earning and withdrawal, so no worries there. Where it gets just a little bit more sticky is with dividends received from non-Canadian companies. So for example, a US stock distributes a dividend to you in your TFSA, you're going to be subject to a 15% withholding tax. And just so that you don't get confused, remember that this 15% withholding withholding tax applies to US stocks as well as Canadian mutual funds and Canadian ETFs, which happen to hold US securities within the fund. And this withholding tax is already collected by the IRS before distribution to non-residents, aka you and me, the Canadians here, so you don't have to worry about paying this withholding tax yourself. So for example, if you currently hold some shares of VFV, which is a Canadian ETF that seeks to track the S&P 500, well, obviously by definition of this fund, it is going to be holding some US securities, even though it's a Canadian ETF. So there is going to be this 15% withholding tax on dividends paid out if you're holding it in a TFSA. And also important to note, this 15% withholding tax only applies to US dividends paid out to Canadians holding those securities in a TFSA and has nothing to do with capital gains. So if, for example, you were holding shares of Apple computers in your TFSA and throughout the time that you were holding these shares, the value of each one tripled, well, when you go to sell those shares later on down the road, you're not going to be paying any capital gains tax because it was held in the TFSA. But what does all this jargon mean anyways and in practice? Well, let's say, for example, you were holding some shares of Apple computers in your TFSA. At the current moment, the dividend yield of Apple computers is right around 0.96%, and taking into account this 15% withholding tax, you would essentially be leaving about 14.4% of that cash distribution on the table and just leaving it with the IRS, thus reducing your actual dividend yield for Apple computers down to 0.816%. So with all this information taken into account with the TFSA, is it even worth it to hold US stocks in the TFSA in the first place, considering the fact that you have to pay 15% withholding tax on dividends? Well, obviously, you're gonna need to take all this into account for yourself and make your own opinion, but in my personal opinion, a 15% withholding tax on US dividends honestly isn't all that much in the big picture of your returns, especially if you're investing in the long term. And if you take into account the fact that historically US stocks have outperformed Canadian stocks by just under 2% annually, this 15% withholding tax on dividends alone honestly isn't that big of a deal in the big picture of your global portfolio. Alright, so now that you fully understand the withholding tax implications for the TFSA, well, how is this applied to Canada's second most popular investment account, which is the RRSP? Unlike the TFSA, where you're taxed beforehand and your contributions are post-tax, the RRSP allows Canadian investors to contribute to this account and then have that contribution count as a tax deduction on their tax return for that given year. Income earned and increases in the overall value of your RRSP is completely tax-free until you decide to withdraw those funds, in which for that given year in which you withdraw your funds, the amount withdrawn is going to be added to your taxable income for that given year. Again, this video isn't about what the RRSP is and how you can utilize it in your overall tax strategy. If you want to learn more about that, then I've made a bunch of videos related to the RRSP on my channel already. However, this particular video is going to be speaking about the tax implications within your RRSP, especially if you're holding foreign securities or US stocks. So we saw with the TFSA that dividends received from US companies are going to be subject to that 15% withholding tax. However, how is this applied to an RRSP account? In this regard, the RRSP actually kind of has a little bit of an advantage over the TFSA because dividends received from US companies that are received within your RRSP are not going to be subject to that 15% withholding tax. I guess in this situation, Uncle Sam decided that the RRSP free and clear, but this new TFSA thing, not going to cut it. But what about taxation on actual increases in overall portfolio value and share value for securities within your RRSP? Well, throughout the time that you hold your securities, you're not going to have to pay any capital gains tax because capital gains tax, even in just a cash account, is only applicable when you go and sell the securities. So later on down the road, when you withdraw funds from your RRSP, typically in retirement, you're gonna have to pay taxes on this. It's not gonna be capital gains tax. It's actually gonna be at your marginal tax rate because withdrawals from your RRSP count towards your taxable income for that given year. And by the way, before we jump into the next account, which is the cash account, if you want to take advantage of an RRSP deduction for the 2019 tax year, then make sure to do your contribution before March 2nd, 2020, which is the cutoff limit for RRSP contributions this year. And if you don't know what your contribution limit is, you can log in to cra.ca and check up on your contribution limit. I just wanted to put that out there because for a lot of people, contributions to an RRSP can really impact how much tax you're going to be paying for a given year. So on that note, let's jump right into the cash account. All right, so now that we've covered Canada's two most popular registered investment accounts, I still want to cover this same information for a non-registered cash account. For those of you who may have already maxed out your contribution room for the TFSA and the RRSP, or for some reason, if you just want to trade in a non-registered taxable account, who knows? Straight off the bat, when investing in a non-registered cash account with Canadian securities, the dividend income that you receive from your Canadian holdings is going to count towards your taxable income as an individual. However, where it gets a little bit tricky is that the federal government allows Canadian investors to take advantage of what's called the Canadian dividend tax credit, which is a non-refundable tax credit with the goal of reducing the overall tax that you have to pay on dividend income. Basically, the whole goal of this dividend tax credit is to make an equal playing field because companies that distribute cash dividends have already paid taxes on them because dividends do not count as a tax deduction, such as, for example, salaries do. So if us, the holders of these shares, receive the cash dividends and then have to pay taxes once again, we'd essentially be paying taxes twice to the CRA on these distributions of dividends. Now, to calculate all of this, it can be a little bit confusing. So if you are confused, please do yourself the favor of consulting an accountant or your CPA. But just to give you an overall example of how this works, in order to calculate the taxes you need to pay on your dividend income, you need to calculate what's known as a gross up value on your dividends received. And starting here, you need to know if your dividends are eligible dividends or ineligible dividends. And then from there, you're going to gross up the dividends received by either 38% from the overall value of your dividends received on eligible dividends and only 15% on ineligible dividends. And then from that calculation, you're then going to be able to go ahead and calculate your tax credit, which is going to be 15% of that gross up value. Once again, if this was gibberish to you, in order to avoid all of it, just start investing in a TFSA and an RRSP. And then if you're at the point where you have to invest in a non-registered cash account, then either consult with an accountant or make sure you fully understand how to calculate the taxes that you need to pay on your dividend income. Now, in terms of capital gains in a cash account, quite simply, if you produce a capital gain on one of your investments, great job, and you're only going to be taxed at 50% of your marginal tax rate, which is a huge advantage of the capital gains in a cash account. And now quickly to cover what happens when you receive a dividend from a US company in your cash account, well, right off the top, you're going to be subject to that 15% withholding tax. And then on top of that, because US dividends are not eligible for the Canadian dividend tax credit, you're also going to be taxed at your entire marginal tax rate on the entire value of those dividend distributions. But with that said, it does get a little bit better because even though the dividends from a US company are not eligible for the Canadian tax credit, they are going to be eligible most likely for what's known as the foreign tax credit. So essentially here, that is a 15% tax credit. So when taking everything into account on a US dividend distributed to a non-registered cash account, you're essentially going to be paying income tax at your marginal tax rate for the entire value of your cash distribution received from dividends. All right, so I know we covered quite a few confusing things in today's video, but nonetheless, I hope you have a better understanding of how taxes work for foreign securities and dividends when held in either the TFSA, the RRSP, or a cash account. If you want to learn more about the technicalities of the TFSA or other investment accounts in Canada, then make sure to check out one of the videos right here that I'm overlaying. And on that note, thanks a lot for watching today's video. If you want to have access to your own free copy of a stock market portfolio template, link down below. And on that note, thanks a lot for watching. I'll see you in the next video.